If you're losing money when you buy options, this could be the reason. Let's take a look at the chart of STM, which is STM Microelectronics. And the reason why we're talking about this specific stock today is because, one, we had some unusual option activity that was mentioned by the talking heads, but it's a good example of understanding when you want to be a buyer of options and when you want to step aside and not be a buyer and listen to just what talking heads are talking about. So if we took a look here at the chart, it's a 15-minute chart. And the reason why we're talking about 15 minutes is because I'm going to compare it to the option contract. So yesterday, prices opened up at 29, sold off, finished at the lows here, and then today climbed back higher, rebounded. This is two-sided trading. There's nothing special about this. Two-sided trading back and forth. What's important is how we were able to close out a 33% gain in less than 24 hours. That's the interesting aspect of what we're going to discuss. So as I mentioned on CNBC, the talking heads, they talked about some unusual option activity. Yeah, that unusual option activity. Well, unusual just means unusual. There's nothing that means more than just that. It's unusual. You have to understand what's going on in the under-market activity. So today, 115,000 contracts traded. That's unusual. But what does that mean? Does it mean they were bought? Does it mean they were sold? That's the missing part. Or are they new positions? What was exactly what's going on here? So just taking a look at this activity, there was some very increased activity across multiple expirations, which is typically what you want to see. A lot of active trading. We could see probably some new positions being put on here. But the key thing here is that 115,000 contracts traded in that August 35 call contract with an open interest of 20,000. Now, yesterday, we can look at yesterday's activity. This is where it's interesting because this is when we got in. This is where my subscribers were able to get in and get in ahead of the move and sell into that rip higher. So yesterday, 22,000 contracts traded and an open interest of 228. So as I just got done talking about today's open interest, we see that new positions were being put on. Yesterday, they were buying, and we know that they were buying to open because we can look at time and sales, and we can do that in real time with the eye in the sky. So looking at that, prices closed on this one at 35 cents. We got in at 45 cents. Market sold off late yesterday. Kind of happens. So when we look at today, prices closed at 65 cents. So we were able, from yesterday's close to today's close, nearly triple the price of those contracts. But as we just got done seeing the stock chart, it only increased from yesterday's low to high of about 2.85%. So 2.85% in the stock, while 100% in an option contract. One of the reasons, and the reason that price increased triple, or there was a triple digit return on that, is because of implied volatility. And that's the important aspect to understand when you buy options. They don't talk about this in books when you get started. You don't really hear too many people talk about it. When you lose, when you buy options, you start to kind of understand or start to learn why exactly are you losing all the time. This is the reason why. Yesterday's implied volatility closed at 55.92%. Today, that implied volatility closed at 61%. 61. So we saw nearly a 5-point move in implied volatility. That doesn't sound a lot, but with implied volatility, that is a lot. 5 percentage points in implied volatility can make or break your trade and make it where prices are flat on the stock, but the option contract, you could see that big increase without the stock. So that's why implied volatility, in some cases, especially with out of the money, is more important than your price direction. So if you could be right on direction and wrong on implied volatility going the other direction, and you could have where you're right on that stock move, but still wrong with the option contract you picked because implied volatility came out or dropped lower from when you bought it. That lowers the premium, and you're sitting on either flat trade or a loss. So as we can see here, we from left to right, we're getting that increase here. So prices hit 65 cents here, close there. And then we see with the stock movement being flat, maybe just a little bit of an increase higher, But implied volatility coming in and rushing in there, well, those options went from 35 cents, 30 cents, all the way up to 65 cents in less than 24 hours. So the reason why you would want to, and the reason why we got out of this position and we locked in a 33% gain is because we don't want implied, in which it will, implied volatility will come out of those options. Because when we look at the delta, which is another important aspect, the delta on these options are 21, and that means there's a 20% chance that these will expire in the money in the next 38 days. That's not the game I'm playing. The game we're playing is to make money and make it as quickly as possible. So while this could pan out to be where someone was buying these options and some kind of news comes out, something like this, if news were to come out, it would be something on the realm of a buyout or some kind of takeover because of such a price jump or a price increase, 29 all the way to 35. And they would have to go over 35 and that premium to actually make it worthwhile. So the takeover would have to be like $37 to really to be meaningful. But when we get that implied volatility here, rush in there, and price direction, that's the double whammy. That's what makes the prices go from 50 cents all the way to $4. Those really big winners. But when we get something like this, where we get that movement in less than 24 hours with the implied volatility, we want to manage those profits. We don't want it to, which will happen because implied volatility is dictated on supply and demand. So obviously we see here 114,000 contracts traded. The demand or the two-sided trading, which is happening here, is increasing that implied volatility because of supply or demand. And that rush is being put into the premium because that's what market makers are pricing the options as. Once this settles down, which you could take a look at tomorrow, that implied volatility is probably going to come in and it's going to lower those options back to where they were trading at before. So we got that pop in implied volatility. It worked out in our benefit. We were able to take an overnight gain and get in, get out, go on to the next trade. So make sure, if you haven't, we've closed out 8 of the last 9 winning trades. We're on a run here. So make sure you get your membership. Make sure you get started.